Bitcoin's best days are already behind it, and that's not hate, it's math, structure, and incentives. Early Bitcoin returns were driven by one simple thing: going from zero to global awareness. When Bitcoin moved from cents to dollars, from dollars to hundreds, and from hundreds to thousands, every new user multiplied its value. That phase is over. Bitcoin is no longer discovering price, it is defending it. A trillion-dollar asset cannot deliver the same exponential gains as a network that was worth a few million. To double from here, Bitcoin needs more capital than most countries' entire GDP, and that alone caps future returns. Another reason is institutional capture. Bitcoin was designed as an anti-system asset, but now it is deeply embedded in the system it was supposed to replace. ETFs, custodians, regulated exchanges, KYC, and institutional whales have turned Bitcoin into a financial product, not a rebellion. Institutions don't chase 100x gains. They chase stability, yield, and controlled volatility. That means slower growth, tighter ranges, and more correlation with traditional markets. Bitcoin now moves with Nasdaq, interest rates, and Federal Reserve decisions. When liquidity dries up, Bitcoin bleeds just like tech stocks. Then there's the supply narrative. Yes, Bitcoin is scarce, but scarcity alone doesn't guarantee explosive returns forever. The halving impact is diminishing each cycle. Early halvings cut massive portions of new supply. Today, the reduction is marginal compared to the total circulating Bitcoin already mined. Markets price this in years in advance. That's why each bull cycle delivers lower returns than the previous one. The pattern is clear: logarithmic growth, not exponential. Anyone expecting another 2013 or 2017 is ignoring basic market mechanics. Security and energy costs also matter. As Bitcoin grows, it becomes more expensive to secure. Mining is now dominated by industrial players with access to cheap energy and political leverage. This centralization contradicts the original ethos and introduces systemic risks. Governments don't need to ban Bitcoin outright anymore. They can regulate miners, tax energy, pressure exchanges, and choke liquidity. The network survives, but the upside gets compressed. There's also the opportunity cost problem. Capital today has alternatives that didn't exist in Bitcoin's early years. High-yield bonds, AI-driven equities, private credit, tokenized real-world assets, and even state-backed digital currencies compete for attention and capital. Bitcoin is no longer the only new thing. It's the oldest crypto asset in a space that now moves faster than it can. None of this means Bitcoin goes to zero. It likely survives as digital gold, a hedge, a reserve asset, maybe even a geopolitical tool. But gold doesn't deliver life-changing returns once it matures. It preserves wealth. It doesn't multiply it. Bitcoin's role has shifted from growth to preservation, from speculation to stabilization. The uncomfortable truth is this: Bitcoin made ordinary people rich when it was ignored, mocked, and small. Now that governments, banks, and billion-dollar funds accept it, the asymmetric opportunity is gone. The risk remains, the volatility remains, but the upside has been normalized. Bitcoin didn't fail. It succeeded so much that it outgrew its own best returns.